decades of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new.
Well, welcome back to the Business Insurance Zone, the talk show that spotlights insurance in your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. In this segment, we're going to talk about all the riders that you can put on a disability chassis. I mean, all in. And there are some that are incorporated into the contract, some that you actually have to pay. You're going to have to make a decision whether there's economic value per rider. And of course, with me again is Marcy Pruitt, who heads our entire disability division in Brokers Alliance. And I can't imagine, I mean, if you took every rider by every carrier that we have and split them between no cost incorporated into the chassis versus, no, these are individual, we'd have to actually break out our HP 12C and actually do some math to see, is that worth it?
Right.
So let's talk about most of the riders that are already incorporated on these chassis, on these basic disability, just to kind of get, those are pretty much standard operation, and those are the ones you always find.
Okay. Well, guaranteed renewable is, and they really varies carrier by carrier. So non-can guaranteed renewable.
Non-cancelable. They can't cancel on you.
Right. And non-cancelable and guaranteed renewable. That would, not only can they not cancel, but non-can actually means they cannot raise the premium. That is built into some carriers. Others, you can pull the non-can feature off, and it will reduce the premium by about 25-30%. And so, again, non-can means that the premium cannot increase. Guaranteed renewable, the features and contract cannot be canceled.
When I'm looking at the difference then, let's just talk about the spread. You said it's about a 25% spread between that and what was the second from non-can versus
guaranteed renewable.
Okay, so if I'm looking at that, I mean, I'm thinking 25% premium difference. How many times as a carrier? I know we can't look into the future, but I'm just thinking basically on the historical past. Have they raised their rates enough to make you cringe and say, no, I'm doing the guarantee?
Absolutely. They really have not. And it requires that they file with the state and prove loss ratios. And that's just not happened. In history, yes, it's happened once or twice, but not, and there's reasons for that, the type of policy, et cetera. And that was early 70s. Really, the carriers have not increased their rates. What they do is they open a new policy series with new pricing and new features, and that's what they start selling moving forward.
So have you seen over your history, I mean, you've been in this game a long time, have you seen the carriers pretty much never approach that 25%? So if I started out at $5,000 and I had adjustments over a 10-year period, I never got to that 25%.
Right, and you wouldn't have adjustments like that. It would be a one-time shot where they filed with the state and everyone in that occupational class was increased. It wouldn't be a continual adjustment. So, and that's why today we see more policies being sold on a guaranteed renewable chassis because, as you just said, especially because females are rated higher, and if you have individual females and maybe in their early 50s, we're promoting the guaranteed renewable because how long, they keep the policy 10, 15 years, and it's unlikely if they were to get an increase in the future, all the premium they would have saved, they're probably still ahead of the game.
So the older if I'm hearing correctly, the older I am, my timeline's shorter of how long I'll have my disability contract, 65, 67. Actually, there are some contracts, though, that go, right?
Right.
I mean, renewal, as long as you're working and you can prove you're working full-time, that go out to, I think you told me some astronomical, I was watching your teaching video, and I think you said something like, what, 75, 80?
75, right.
Was it 75 as a cap?
Some will go lifetime, but 75 typically.
As long as you had gainful employment. I mean, I even thought about it. I always thought disability died at 65. But if I had my timeline, and I'm looking at a 10, 15 years, the odds of it actually increasing up to 25% is pretty remote. I mean, it could happen.
Right, it could happen,
but it's remote. Okay, based on that number, and I'm looking at the bang for the buck, I may want to go this other way then.
Absolutely.
So when you see sales, what's it going right now? Is it pretty much guaranteed or no?
We're seeing more again in the older market. They're willing to take that chance. You want to be sure that you explain that what can happen
in blood.
Yeah, sign off on it. Put that disclaimer there. But we have not seen the increase like you've seen in long-term care policies or even years ago universal life policies.
Is it fair to say, and I don't know if this is fair, but I'm asking you, is it fair to say that really underwriting DI has become a really great morbidity science, and that's why you don't have these increases, because they really know how to price it day one?
Well, they do, and it's not, they underwrite it. It's not tied. It's not cash accumulation. It's not tied to the interest rate. Certainly that's how carriers make money, and their return on equity, they shoot for a certain percentage, but they are pricing it and underwriting it so that they hit the ROE level they need to hit, which is why, they don't even go to the states for the increase. They close a series down and open a new one because they don't have the loss ratios to prove to a company, to the state, that they deserve the increase.
When I'm looking at riders that cost me money now,
right?
Okay, let's talk about that for a second. Let's talk about the two most popular that people are willing to pay a little bit more to put this on their DI contract because you think there's some economic value to that. Talk about the first one.
Well, the residual, we talked about ONOC, and depending on what ONOC rider you add, it could add 25%, but it also, depending what happens to the mental, nervous, drug, alcohol provision, that kind of washes it out, and that can either be an unlimited provision or a 24-month limitation. So otherwise, residual is a very important rider. It will pay in the event of a partial disability where you go back to work and you're suffering a loss of income. And again, most claims can.
Well, you're going back to work in your occupation, or just going back to work?
It can be either one, depending on your own op.
Maybe you're
going
gradually
back to work.
going back to work, so it's going to pay the difference.
Right.
Okay, it's going to modify.
It'll pay a proportionate amount of if you're suffering a 50% loss of earnings, it pays 50% of your benefit.
In residual, what kind of a price tag have you noticed is like?
That's kind of high because many claims are residual in nature, 25, 30%.
Increase on the chassis.
On the chassis.
To make sure you're covered on that.
Correct.
And do you see a lot of people purchasing it then? Because that's kind of pricey, but they're still purchasing it.
Because most claims aren't total in nature. And back to the ONOC claim, and this varies carrier, but industry-wide, true specialty ONOC claims are only about 2%, because they either don't go back to work or they go back in what they know how to do. And ego, from an ego standpoint, an orthopedic surgeon, if they can't do orthopedic surgery, are they really going to teach? They may, most of them retire, or they go back to what they know how to do.
So I wonder if their egocentricities are specific to their occupation. No, I guess not. Give me another rider that we
cost of living. That's a 10 to 15% load. And that can do a lot. If you do not add the cost of living rider, your benefit will be frozen for your entire claim duration. And if, especially a young professional, if you think inflation's going up, that is a good rider to have, because a $10,000 benefit today won't be worth $10,000 5-10 years from now.
And I think some people may say, hey, 10% more of whatever the contract or the policy's base cost is. That's a pretty good idea.
Right.
I mean, especially the younger you are, I think you're right. I think the timeline proves that that's an economic. What other ones would you want to put on there that might be of value? Today,
the catastrophic rider is one that we're seeing more of, and that is it's about a 10% load. That will pay an additional benefit on top of your base benefit if your disability is catastrophic in nature.
Now, I noticed this language. I'm just asking because I just want to make sure everybody hears this right. To qualify on the issues of activities of daily living, is that the same as it is in long-term care?
Same premise, yes. It's if you're suffering the loss of 2 of your activities of daily living or cognitive impairment, so like long-term care essentially, they will give you, depending on how your contract was set up to $8,000, and that's spelled out in your contract, or 100% of your income.
Do you have the list of the 6 ADLs in your office?
Yes, it's the same as long-term care. That's bathing, dressing, transfer, incontinence.
If you don't have it, of course, just
call
Marcy at 1-800-290-7226. Her extension is 126, or just write her on email at marcy@brookdale.com. brokersalliance.com, because we always we talk about
Right.
these things. We say, yeah, we have it, order it.
Right.
Yeah. And you can also sit down if you say, man, I want to do a teleconference. I want to do a phone call interview with Marcy to walk through this. I'm a newbie to the business on the DI side. Maybe I know securities. Maybe I know life. Maybe I'm coming out of. We're seeing a huge exodus out of the medical because of
Right.
Obamacare. People are coming into our business, and you say, but I just don't know how to even start with this. I got a couple good clients. Marcy's the gal you want to talk to. Marcy, when I'm looking at any other writers that you
The
do you kinda
purchase
like?
option is a very inexpensive rider, because when you exercise the rider is when the cost comes into play. And what that feature allows is it protects your future insurability. So you buy a pool of money or the limits that the carrier offers. Most carriers will issue $15,000 to $20,000 on their own paper. Some will participate higher than that, mixing it amongst carriers. So this allows you a pot of money for young professionals. As your income grows, you show your 1040 and you do not have to pay, you don't have to go through medical evidence.
And what kind of percentage did you think that was?
Well,
now?
it's like 3%. It's a dirt cheap rider.
Well, really, the
when
ones
you
you've-
bump your benefit up is when the cost comes into play at attained age.
Well, the one that so far the cost of living, the catastrophic, and the purchase option rider seem to be decently priced. The only one that seems to be a little pricey is the residual.
Well, and that's that's built into some carriers, so it's just you can't even unbundle it. Otherwise, I think the more it costs, the more it does for you. The fluff ones don't cost anything.
Oh, I like that technical terminology, the fluff ones. Well, are there any other ones you want to bring up on the show that you think are worth, as far as writers, that you have to pay for?
Not really that you have to pay for, no. Those are really the riders, and I don't
Those
think
are
I'm
the big
missing
four.
the ONOC, the residual.
So, like in my world of
Cola.
life insurance, I have this return to premium on a term chassis. Can I get return?
Thanks for reminding
I do.
me. Well, return
they
it.
say I
and
don't
you know
know
because
DI.
nobody ever. It's rarely sold, I should say, because it is a 60% load.
Wow.
And what happens is, depending on the carrier, there's 3 I think that sell that now, and either including the load. So let's say your premium's $1,000 a year. Now your premium's $1,600 a year. Every 5 years you get $800 back. You get less claim. You get half of your premium you paid in back.
Well, the interest rate's so low, maybe I don't care.
Yeah, and they say the return on that's about 12%. But who buys term and invests the difference?
Nobody. Well, listen, Marcy, I want to thank you for being on our show again today and breaking out the writers and the ONOC issues. That's huge. Remember, you can talk to Marcy, 1-800-290-7226, extension 126, or write her at marcy@brokersalliance.com. Hop out to our website and visit us, www.brokersalliance.com, where you can always check in on life, disability, long-term care, and pension. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the Buzz on the Biz for today. Get into the zone. The Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.